Well, happy market day to all of you and that have attended our market action webinar today, and we hope you had a good trading day. I'm Don Prattle from TradeStation, and that distinguished-looking gentleman in the chat panel is David Russell, and we're here to talk about market action today. One of our favorite times of the whole week as we gather to talk about what is important in the market, what happened today. Stock continued to move higher through the week last week, and it was extremely volatile. As of now, the government shutdown continues with seemingly no chance of an agreement anytime soon. And starting today, we had another round of quarterly earnings and some really big ones are set to kick off this week. There are a number of economic reports that will be due out this week that should also move the market, but the market's been pretty volatile all on its own. That's me. I'm in the background there. I'm Don Prattle, the Director of Trader Development and Education for TradeStation here, and I've been here since 2016, and I have been around the block, as they say here in Chicago. I am very happy to have as my colleague in this endeavor here at TradeStation, David Russell. He's the VP of Content Strategy at TradeStation, and he draws on a lengthy experience as a journalist and as an analyst, and his background includes observing equities, emerging markets, fixed income, and derivatives. He comes to TradeStation from stops at Bloomberg News, CNBC, and E-Trade Financial, and he's going to give us a pretty good analysis because David reviews countless global financial headlines and indicators in search of broad tradable trends that provide opportunities repeatedly over time. He's going to share many of those with us in the next half hour or 45 minutes or so. Now remember that our presentation here is for educational purposes only. All the symbols, all the trading ideas, and everything we discuss are for demonstration purposes. They are not recommendations. Our presentation is not an offer or a solicitation of any kind anywhere where a TradeStation affiliate is not authorized to do business. Remember that active trading is not suitable for everyone, and options trading itself carries a high degree of risk. It may not be suitable for all traders. We've included for your reading pleasure the characteristics and risks of standardized options brochure from the Options Clearing Corporation. The link is in the chat panel, and there is another document regarding other important information about asset classes that we trade here at TradeStation. Before we start, I've got a couple of small bite-sized commercials. Very soon, in the next, by the end of the month, or at the end of the month, January 28th through February 1st, we're hosting another TradeStation Masterclass down in our TradeStation Plantation, Florida headquarters, where you'll learn how to master the TradeStation platform in just 1 week. If you click on that button in the top banner, you'll notice the registration page and be able to go through the process of registering for this great event. During the 5 days that you're with us in Florida, you'll be taking a deep dive on the TradeStation platform, study strategy development and testing with us, and also get a complete course in our easy language fast track programming. Spread across the 5 days, we've got a number of great social events that are pretty fun, and some unbelievable guest speakers will be here with us as well during the week. So take a look at that registration page, and if you have time at the end of the month, join us at our plantation headquarters for the TradeStation Masterclass. If you're not a reader or of our Market Insights blog, well, hopefully after today you decide that you do want to become a regular reader of the Market Insights blog. David Russell and other writers here at TradeStation make contributions to the blog every single day in the Market Insights blog. It's loaded with market commentary, education, and breaking news as far as we can tell from the TradeStation side. And David's our primary author there. He'll have some insights on some of his articles as we begin the presentation today. So I want to turn things over to David right now so that he can jump in with his sharing his screen and begin our market action webinar. Thanks very much for coming to TradeStation today. I'll be around. If you have questions in the chat panel, we'll get to them as quickly as possible. David, how's it going up there in Chicago?
Oh, it's good. Thank you, Don. It's good to be back with everyone. All right, let's go to my screen here. All right, so we are basically looking at the TradeStation homepage. Just in case you guys don't know, go to TradeStation.com and then go up here to menu and click on, you can't see, but it says Market Insights. Take you through to our blog. Most of the things we're talking about have been covered in the blog in different ways. And we always do a summary beforehand so you guys know what we're going to be talking about, some of the links. It's a market action summary right here. And this is what we're going to be working off of, so it's right there if you want to follow along. So we always start off with an overview of the S&P 500. And I think it's important to realize as we look here at the cash index to start that there have been some important levels. We had been talking about 26, this was a while back in mid-December. We had said a break under 2620 on the cash index was trouble, and that's pretty much what happened. But now we're back to this kind of 2600, 2600 now, up to 2600, 2620 is this kind of like zone here. I think it's important to think about a few things. This sell-off in late December was one of those just freak events that happen sometimes in the market. It was low liquidity. There was no one wanting to own based on the kind of window dressing, bad quarter. When you're in like a bad quarter, no one wanted to own until the quarter is over. In my view, one of these things like what we saw here, this drop in the second half of December, was in many ways a freakish capitulation sell-off that things like this just don't happen often. They happen sometimes because of the mechanics of the market. So I think we have to be careful of expecting too much in terms of more follow through to the downside here. This is probably one of the weirdest environments I've ever seen. Tomorrow, in theory, we're going to have a vote in Britain over Brexit. We have this whole thing with the federal government and shutdown. And, in my opinion, this is from an index point of view right now, when you look at a lot of these things here, there's a lot of arguments that can be made for this being resistance and further downside coming. But at the same time, if you consider the fact that in many ways you can also argue that this breakdown never should have happened in the first place, that it was a result of strange seasonal, strange end of year illiquidity, then maybe this level is not as important. So I think right now, it's easy to just draw a line on a chart and say, oh, it was support, now it's resistance. But then there are some other ways to think about that. So I'm going to show a few things that I think are interesting here. This is the high yield spread on the St. Louis Fed website. If you want to look for that, if you just Google, the high yield master Fred spread. I mean, it sounds crazy, but if you Google that, you'll find this. This basically shows junk bond spread spiking and then coming back in. This is bullish when it tightens and it comes down. It means risk is removed. Another thing to look at, these are the banks that are tightening loan standards, and you see it's going down. And then this is for commercial loans, also trending lower. You'll notice before recessions, it trends higher. So these things are not recessionary. Now, we also have a little thing happening over here. We go to my radar screen. We look here at the TYX, $TYX.X. That's going to be your 30-year bond yield. Now, if you look right here, you can see it rose 0.23 today. And if you look now at the 5-year, it rose 0.04. We do not have the 2-year yield on here, but the 2-year yield actually fell today. So we're seeing the long end of the curve rise in yield and the short end of the curve fall in yield. Well, suddenly we have a steepening yield curve, and we have Citi come out with an earnings report that was so-so. Everyone says, oh, bad revenue is bad for the banks, and suddenly this company is rallying. There was an article on Reuters that said that basically that Citi is seeing improved lending, consumer lending. The banks are trading at book value. They're massively capitalized. If you look at their risk levels in terms of like the capital ratios, they are very much like they're like in first gear in terms of the risk they're taking. This is something now where it's hard, I think, to really look at the banks and not to be viewing them as a value play. The charts look terrible. There's been a huge amount of negativity because of the thing with the yield curve. But these banks now are starting to look like a value play. And, I mean, the thing is this is, it's not like a terrific trade at this point in time. I'm not even necessarily saying that they're necessarily like you want to be buying them. But what I'm saying is it's hard to really argue for the S&P chart to lead us to the downside when you see the banks coming off lows like this, and when you see some of these other economic things that have been happening. So my view right now is that this is not a great setup for index trading. I think right now what we're going to see is the S&P here could very well just kind of move sideways, and then we'll wait and see. There very well could be another push to the downside based on something involving the federal government. But the thing is that we don't really know how to approach that or how to time it or anything else. And I think right now at this point in time, it's better to be kind of looking past the index. We have seen some things that suggest that the bearishness has really diminished. So if you take a look over here, for example, we look at the VIX. The VIX had its biggest drop. Really, this decline in the VIX was the most dramatic since February. We've seen a lot of risk kind of come back out of the market, a lot of fear come back out. And when that happens, you don't want to be complacent, but at the same time, you cannot just assume that the negativity is going to come back like tomorrow or the day after. There's definitely an argument for more downside in the S&P, but the problem is it now or is it in a week or two? And the thing is I just read an article right before, it was on Market Watch, and it said basically that the amount of money in money market funds actually just rose to its highest level. I just saw it here somewhere. No, it was on CNBC. So we have the most money right now in money market funds in 9 years, pretty much. So I mean, this is all these things when you look at them are just not very clear in terms of anything. And I think right now, my point in all this to be very simple is I don't think we have any clear trades in the index right now. I think what we want to be looking for is individual stocks just moving on their own accord. And, we're going to have some of those things that, have the potential for that. But I wanted to just emphasize that. Now we're in a spot where it's going to be looking for individual names to make kind of, they'll move from point A to point B on the chart. And those are some of the things that I think we want to be looking for, right now. So I wanted to point out in the beginning that some of the IPOs that we saw last year, I'm kind of a believer that, I like to see IPOs weather and season a little bit. And some of these names that kind of came out last year are starting to come to life now. And I think it's time to go back and take a look at some of these because we have seen money moving into some of these. Tilray, for example, has been coming back to life. This is a marijuana company. Companies like Zscaler. I mean, you might not have heard of this, but this is like, a cloud computing stock that has been, every earnings report has been strong. And here it is pushing to its highest level really since September, when most of the NASDAQ is nowhere back to those sort of levels. So there has been money drifting into some of these newer IPOs. And there are some other names that I think are interesting right now. We have seen outperformance in the small caps. And there's been, let's take a look over here at the level of our indexes. This is a special thing I have set up in Radar Screen. What we're looking at here is we're looking at essentially a bunch of ETFs that track different kinds of indexes and sectors in the market. I like it because it's, it's basically just a list of things that you wouldn't maybe think of right off the bat, but things like home builders, it's not exactly just tech or something. But what we kind of see is we see, Brazil is continuing to be the overall best part of the market right now, the Brazilian ETF. We've seen a lot of money moving into these Latin American stocks. There's a new president down there, and we also have this idea of now that the Fed is being more dovish, that kind of, maybe it doesn't make us totally bearish on the dollar, but it's going to make people a little bit more interested in owning some of these, weak dollar assets or some of these emerging market assets. There's a lot of interesting things in Brazil. And I mean, you're really looking at something where it was such a mess. And like, the people who were running the country, when I first started my career, Brazil had just ended a good kind of period of fixing their economy. I was way back in like the early 2000s and I was covering emerging markets. Then Lula came in and basically it's been stagnation ever since. But now that is over, and now we have a pro-business administration coming in. So we have a bunch of articles here about what's been happening in Brazil, some of these companies you might have never heard of. But I think it's interesting just to kind of look at that and start to look at some of these names. Some of these names have definitely been outperforming, and there seems to be a shift toward Latin America in the new year. And the thing about them is that they're not all obscure. Some of these stocks do trade a lot of options. They're pretty well known. And there have been times in the past when these were very popular. So I think we want to kind of, just hone in on some of those. Now, another thing is we did an article about companies that were pushing new highs. I think it's interesting to look at companies that are pushing highs at a time when, when the rest of the market is still not near highs. So we actually have an article here when we kind of run through those. And, we have this scanner essentially set up. These are companies who are pushing new highs, things like Twilio and stuff. But there's a scanner I set up right here. And what it looks for is it looks for companies, I call it just hitting highs. But we have this little, indicator that I have right here, which is called distance from 52-week high. So basically, I can just go ahead and I've added it here to my S&P 500. But this indicator essentially lets you find companies that are close to their 52-week highs. I look at this a lot, and I've mentioned it a lot, but I think it's good to always just kind of revisit it, from time to time. And we can kind of see, Red Hat's getting acquired, but then you have some other companies no one has ever heard of, like ResMed. Now, it doesn't trade a lot, but I mean, this is an S&P 500 company. It's a member of the, healthcare area. And some of these companies are, basically unfazed by the weakness in the market. And what you'll sometimes see with companies like this is they in this kind of environment, they can just push some highs and then just start to break out. And I think, these are some of the things we want to just be kind of looking through. ResMed to me doesn't trade that much, but it's interesting just to look at that. Now, one that is on my list that I think is, I can't believe that I would actually say that Facebook can go higher, because like for me, Facebook has been just this untouchable stock. But Facebook right now is a company that reports earnings in a few weeks. And now here it is, pushing back against this level here around 146. In my view, you could see that, Facebook here, it could have a run up of about, kind of 5 to 8 points maybe, up, up toward over 150, I think, because it has a lot of time. And the thing is there's a lot of negativity in this. And the question is, if you've been hammering Facebook to the downside, do you want to necessarily stay short as earnings approach? There's very much likelihood that it goes the other way. This is a purely sort of technical trade, but it's one of those things where, the likelihood right now is more of the shorts covering to the upside with it back over the 50-day moving average. We also see bullish divergence here. So for me, these are a question of some short-term trades. Another one that's interesting is Regeneron. The biotechs have been very strong, and this company here now is basically pushing, again, against a resistance level from here. When I just look at these, these are just a sort of thing where I think in this market, the S&P can kind of drift and do nothing, and individual companies can break resistance and go on a little bit of a run. That's the sort of thing I've been looking at here. The other names that I've been interested in that have been working on this front have been Pluralsight, which I had identified before as it pushed up to this level, has a huge amount of short interest. It's a relatively new IPO that's had some strong numbers. And the other one that I've been liking has been Etsy, which I've mentioned from time to time. I'm just watching it right here, but this is a company also that is above its 50-day moving average, the red line on the chart. In my view, these are some of the kind of companies that can just inch higher as the market drifts. We had mentioned Glue Mobile as well, and this one already went to new highs. It was back here last time, and then it just went to a new high. So this is the sort of thing you can see in this kind of market, in my view. Don is looking at financials. He's kind of, been looking at some of the same stuff I think we've been seeing, kind of two sides of the same coin. So, Don, we had good numbers today in Citi. What's up next in the financial space?
Well, I don't often talk about banks. I haven't really. Remember that banks were supposed to rally in 2018 as they captured all the lower interest rates, right? Volatility, however, popped back into the market and thumped a lot of the large and the small cap names. The performance of the financial sector remains really dependent on how the Fed approaches its monetary policy going forward, as you pointed out. The ETFs that track as you have the which one on the screen? The ETFs that track
the XLF.
Yeah, the XLF tracks the banking sector, and like some of the other ones I looked at, it's the flattening yield curve that's a result of the aggressive tightening by the Fed throughout 2018. It dampened investor sentiment towards that financial sector, and the markets are perceiving that as the bank's ability to generate earnings. That they're now under a little bit of under pressure to find other ways to make revenues. We looked at Citigroup. So to start, and it unofficially kicked off the major banks team for the, like I've got that football, I've got a football hangover going on from yesterday. I wouldn't say officially kicked off because the big banks are still to come, but they released their quarterly earnings before the market opened today, and they earned $1.20 during the same period last year, but the stock has lost 15.5% since the end of June. This started the earnings season for banks, and it did deliver some positive earnings surprise in the way, I guess, almost a 4%, 3.9% in the fourth quarter. They backed that up with messaging on expense control, the lower cost of credit. Their adjusted net income per share of $1.61 for the quarter was a lot bigger than most estimates were of $1.55. Also, adjusted earnings climbed 26% year over year. Their adjusted net income was $4.2 billion. That's up 14% year over year, and it includes the impact of tax reform. Net income came in at $4.3 billion, or $1.64 a share. Now, the company itself has displayed prudent expense management throughout the fourth quarter. Higher equity market revenues, along with loan growth, were positives as well. But investment banking revenues have disappointed the experts, as the advisory business was more than offset by the lower underwriting fees on lower market activity. So as the banks begin to leave the traditional lending for other avenues for income, they're not, especially in this messaging, they were not. Citigroup was not successful with that, but their costs of credit for December year-end that quarter were down 7% over the year. That fall underlines the reduced net credit losses of $1.8 billion and a credit reserve build of $111 billion. So, but tomorrow, the big bank, the leader. This is the J.P. Morgan is the one bank that many experts believe is their darling. It's the darling of analysts. It's provided both offensive and defensive characteristics. They'll kick off the official earnings season with their fourth quarter report. The company will report before the market comes out. The consensus is calling for earnings of $2.25 per share, $2.25 per share. During that same period last year, the company earned $1.76, and the stock right now is down 5.5% since the end of June. Now, Jamie Dimon is a industry prognosticator. He's their CEO, and he actually weighs in on a lot of business, just all kinds. I'm sorry.
He's got a big mouth.
Yeah, that's what I was trying to say that delicately. Thank you. He recently was quoted at an industry event saying that 2019 could be the fastest global growth year on record. But then he turns around and says a slowdown in 2020 does seem likely. So I don't know. It's good for him to think that we're headed for a really good year this year. I'm glad he does. Actually, it's that kind of positive attitude that will help investors make their minds up on their choices. We like to be positive here. The International Monetary Fund expects global growth to come in at about 3.7% in 2019. That's lower than their previous 3.9 estimate. The World Bank isn't nearly as optimistic as Jamie Dimon either, and they expect global growth to slow down to 2.9% this year. So take that all together, and it still seems as though we could have a pretty good year in 2019. For the fourth quarter, J.P. Morgan is expected to report earnings per share, as I said, of $2.25 on revenues of $27 0.28 billion, according to some third-party consensus estimates. In the same quarter last year, earnings per share came in at 51.76 on revenues of 25.45 billion. And then since you grew up in the industry, David, and I spent many years working for much larger brokerage houses than TradeStation. God bless TradeStation, however. There was a piece of news that I found that I thought was pretty optimistic, and that is regarding the employee bonus pool at JP Morgan. The company is set to increase its employee bonus pool by 3% for 2018. That's based on a Reuters report that I found. Now, that's a perk for its investment banking division leading charts throughout the year. Individuals in the company are going to hear about their particular bonuses next week, according to the report, which also notes, and this is a well-known thing, is that JP Morgan is well known for being tight with pay for their revenue-generating employees. Its equity trading division can expect bonuses. So their revenues are coming from areas other than commercial banking and with trading leading the way. Revenues in the trading division were up 17% in the third quarter. So that announcement tomorrow will be it won't just be us looking at JP Morgan's news. It'll be at the internal company. I mean, traders in various divisions on Wall Street, the big time traders, they fully expect, 50 to 75, in some cases 100% of their salary as a bonus. So this is a big deal for how healthy that company is. Now, on the other hand, on the 15th, Wells Fargo joins the list of banks that are reporting their earnings before the market opens on Wednesday. Did you have something on JP Morgan, or did you have an opinion, Dave?
No, I my view of the banks is I find it difficult sometimes to even distinguish massively between them.
Yeah.
For me, it's just a question of when I look at right now what's happening. It seems like that boogeyman of the flattening yield curve is actually going the other way now, and it's quietly happening. But it looks like it's happening for the time being, and to me, that's the main driver here with these banks.
We've talked about this offline to those of you that are listening in. David and I meet on these topics regularly. The idea that that I would even talk about banks, I knew. It's not the sexiest part of the marketplace, that's for sure. But the reason I thought this was critical for us to discuss it today is because the Fed activities and the interplay between the White House and the Fed chair and the various Fed governors as they are out on the street, that's been a huge news source for us in the financial industry. And so these. How the direction that these banks take really kind of drives the bank, drives the stock market in a lot of different ways. Although they themselves may not be so impacted. Those interest rates will go right to the rise in interest rates. Will go right to their bottom line, or a raise, a lowering of interest rates will go right to their bottom line. But a company that has been its own worst enemy from any business sector throughout the course of 2018 has been Wells Fargo, and as I said, it's going to report on January 15th. Now, financials across the board have been punished severely, but Wells Fargo is no exception. The stock is down about 25% from highs earlier in 2018. The dip in Wells Fargo seems surprising, given that the bank has already traded at a very significant discount to the broader market. The banks just can't seem to catch a break, and just recently agreed to pay another $575 million in fines related to the violation of consumer protection laws. I mean, what's $575 million, right? The bank is also months behind in complying with risk management policies, which have been implemented by the Federal Reserve to prevent abuse of customers following the sales scandal that took place back in 2016. But despite all of this, investors don't need to be fearful of the recent dip, but they should embrace the opportunity perhaps to keep an eye on this stock for maybe some sort of a recovery. As your chart there, it looks somewhat positive, at least short-term wise.
Yeah.
For longer-term investors,
I agree. There's been so much negativity thrown at these companies, and I think it's just important to realize that these guys are trading close to book value, and they are not really running in high gear in terms of their business. So we have added a lot of debt in the economy at the level of the federal government, but like things like mortgage lending and a lot of other stuff that banks do really has not been that. There's no sign of it really having any trouble. At this point so far, you read things, there's a lot of leveraged loan debt and all that stuff. You can say that all you want, but then when oil moves higher, it takes a lot of that away. So this is one of these things where we're in the middle of an economic expansion, and you can say it's going to end, and at some point it will, but there's just a lot of negativity that has been thrown at this market. And in my view, the things I watch, jobless claims, non-farm payrolls, ISM manufacturing, and I also look at rail traffic. None of these things are flashing recession yet. In fact, look at this, the Atlanta Fed GDP now estimate. It's still like trending, sideways and maybe higher. This is what they're seeing, in terms of the, the fourth quarter. You can say all you want about things like the shutdown, and I agree, it is a potential risk that can cause trouble. But at this point in time, we have a lot of negativity priced into the market that is not confirmed in the economy. And, who knows how long the shutdown could last. It could obviously hurt some people, but at the end of the day, the question is, at the end of 2019, if you're a money manager who needs to be making money this year, do you want to be out of the market in January because there was a government shutdown? And usually the way these things have worked out over time is that, you feel like a fool for not owning at moments like this. That's usually what has happened, in history. And so that's how I think these things are shaping up right now. And I agree with Don. I think right now these banks, they're just, the fundamentals in them have turned in a positive direction, and we don't see the kind of trouble that confirms downside in the banks. Don, one I'm looking at that I think is interesting is Goldman Sachs. Here you have a financial where they thought that it was going to get sued by Malaysia and all that stuff, and these are just outlandish sort of things for something like Goldman Sachs to get sued by a foreign government. You can, things like this in history usually pass. When you look at they sound scary at the time, and then you look back. I've been a financial journalist for 20 years, and I remember all kinds of crazy things like this that they just go away. So in my view, the one I think is interesting here is Goldman Sachs. They're going to be reporting on Wednesday, right, Don?
Right, the 16th, and they've raised my interest as well. It's trading below book value by billions of dollars, and this is a company that provides indispensable services to its clients around the world, including investment banking, institutional client services, investment and lending, and investment management. So that seems kind of strange that it's so far below its book value. But as you just pointed out, part of the reason for this, roughly, what is that, a 30% drop or something like that in the share price on the screen, it's all about these criminal charges being filed by Malaysian governments against Goldman Sachs. They're seeking damages in excess of the $2.7 billion that Goldman Sachs has. Actually, they've already earmarked that for payment to the government, $2.7 billion off their bottom line, and yet they're getting sued for more. So that's going to be scrutinized. Their results on the 16th are going to be scrutinized to see how much the scandal is costing the bank. But one of the more favorable trends about Goldman, the thing that I think we both find attractive, is that that this company has been involved in some of the most complex transactions on the street. They consolidate leadership in the financial world. They have a reputation for excellence And investment banking clients are increasingly demanding, and they require larger financial transactions than they've ever required. And Goldman Sachs usually is their first stop and can deliver on those kinds of demands. But so it's a favorable trend that I think we can associate. It's that they're sustainable, that they actually have, they're going to have good earnings. And that's taking place across all their business divisions. So we should look for good results from them on the 16th.
So let me just mention one other thing here is that apparently Goldman Sachs is going to be involved with the IPO for Uber. So we have an article here about upcoming IPOs this year. So just something else to watch for as people look at IPOs. And this is going to be a story that, most likely CNBC and the Wall Street Journal are going to jam down your throat and beat you over the head with 10 minutes, 10 times a day once this starts to happen. Morgan Stanley and Goldman Sachs are the underwriters for Uber, and Lyft hired JP Morgan. But Uber is going to be a story this year that people are going to just go crazy over at a certain point in time. And I think that's another thing to remember with Goldman.
The last one of these companies, David, that I really wanted to talk about was another stop on my own resume, Morgan Stanley. They are due on the 17th. They are expected to deliver a year-over-year increase in earnings on lower revenues when it reports the results. This has been kind of leaked out for a few weeks now, and this gives a good sense of the company's earnings picture. But how the actual results compare to those estimates is a powerful factor. Now, the stock might move higher if those key numbers top expectations in the upcoming earnings report. But if they miss, they could drop off. Now, the investment bank is expected to post quarterly earnings of 91 cents per share in the upcoming report, which represents a year-over-year change of actually a positive 8%. Revenues are expected to be $9.4 billion, and that's actually down almost a full percent, but down 0.6% from a year ago quarter. Now, the consensus earnings per share estimate for the quarter has been revised over the last 30 days to the current level, and this is essentially a reflection of how all these analysts that have reassessed the earnings estimates over the period. Everybody that is interested in Goldman Sachs should keep in mind that the direction of estimate revisions by the covering analysts may not get reflected in the aggregate change. And just, we talk about what analysts think of stocks every single week when we're here. And they, when earnings surprise the analysts, should we ever consider that to be something worth tracking? Analysts often consider to what extent a company's been able to match consensus estimates in the past while calculating their estimates for future earnings. So it's worth taking a look at the surprise history for gauging its influence on the upcoming number. An earnings beat or an earnings miss may not be the sole basis for a stock moving higher or lower. Don't forget, many stocks end up losing ground despite good earnings due to other factors that disappoint investors. Unforeseen catalysts can help a number of stocks gain despite their earnings miss. Can you still hear me, Dave?
Yeah, I'm here, Don.
Okay, very good. It's just there's an issue here in plantation. So having said, having positions in stocks that are expected to beat earnings does increase your odds of success, but where it relates to Morgan Stanley, they don't appear to be a compelling earnings beat candidate. But when we're looking at this company, we might want to pay attention to other factors before, reasons for investing in the company or perhaps walking away from it ahead of the earnings release. All these companies, what I find fascinating is they all have they realize that how the Fed actions affect them. Things are uncertain necessarily with interest rates in this upcoming year, and so they've begun to ramp up other industries, other categories of businesses that they follow. So that's it for the banks.
No, I agree with this. I mean, this is to me something now that the pieces are coming together on it. When I start to see the steepening of the yield curve, the rotation that we're seeing, the banks have not really had a good year in a while, and where the economy is, I think it's one of these things where big institutional money likes a space like this. It's interesting. Another company that's a former mighty company that has kind of shown some signs of coming back to life recently is General Motors. There's been a lot of positive news from General Motors really for the last year. I mean, it seems to me like Mary Barra will probably go down in history as one of the great CEOs in the last, several decades. People hate General Motors now for a myriad of reasons. I think that historically it's been a lousy company because I think that, quite honestly, the dealership model has all kinds of issues. The way they have to support dealers with loans and stuff. It's always caused some very conflictive business. But they have cleaned up a lot of things, and they are really focusing now on these SUVs, and they're really in a part of the market now where it seems like this company is really starting to show signs of a turnaround. So the sentiment is getting increasingly positive on General Motors. And here you have the 50-day moving average coming up. It's about to break through the 200-day. And to me, this is similar to some of these other sort of stocks like the financials, where there's a lot of value in it. And like you can, see monsters under the bed of the recession all day long. But the fact is that this is a consumer discretionary stock in an environment where we have more job openings than jobs, and we have a proclivity of people to buy expensive, high-margin vehicles, and gasoline prices that are not stopping that trend yet. And I think we have a narrative here. Sometimes you will see a very bullish narrative in place. Well, you'll see bullish fundamentals, and the market will just ignore it, and then suddenly everyone cares. And I think GM is potentially setting up for this. So for me, GM is almost, the chart does not look that different from something, like I had recently mentioned Exelixis, which has been probably my best trade so far this year. And it was just kind of, bottoming out, and it broke the 200-day and it just shot higher. And to me, we've seen this kind of set up on a few charts, and General Motors is not that different. Where basically like all of last year and the year before were just a wash. But as it was doing that and consolidating, you just saw good news, and the market didn't care. And now I think we're in a position for GM now where I think GM is setting up for a potential breakout. It's interesting to see a stock that's over its 50-day moving average, over its 100-day moving average, when the rest of the market is not. It tells you that this is something now where there has been that shift. General Motors has a lot of options liquidity. This is the kind of company where you can do stuff with the calls. And I think right now, I'm not going to say there's a setup exactly here right now, but to me, General Motors is in that position where it could easily squeeze higher, and it could run up to like 44. Because when you really think about it, this stock really has gone nowhere for years. And if you're an institutional investor who's looking at a company like GM and you're thinking like, wow, this is a turnaround company, and in 3 to 4 years it could double in value, it doesn't really matter if you buy it at 38 or at 42. People who believe in it as a long-term turnaround play they'll just be buying it all quarter. And I think we could start to see that in GM. So my view in GM is if this thing starts to run, I think it can keep moving, and it's a great stock for options. Unfortunately, right now, we're in a setup where I don't think there's going to be a lot of really, like the big moves, the big volatility that we had in December. We have to accept that that's not going to happen now. I think that, GM running up 7 or 8%, that might be as good as it gets for right now from a trading point of view. I hate to say it, but we have to trade the market we have, not the market we wish we had. It'd be great if we all have December again and play it back and, play all the volatility, but we don't have that market right now. I did mention Exelixis. There's been buying in the biotech space. To me, this is a company that is, I've watched this name for a long time. This is a great, well, I don't want to say great, but this is one of these oncology stocks, cancer treatment, that has been just an absolute monster. And the thing is that the earning, this is one that we forget about for a while, but then it's like, wow, this stock went from 5 to 30, and then it paused and pulled back and had a bad 2018. But now it looks to be, moving higher again. It's over all of its moving averages. I'm looking here for a pullback toward 22, but I think this is a name here where, even without the merger activity in the biotech space, this name had multiple. See this gap higher? That was some kind of good news. I think it was earnings, but they've had some drug trials as well. So I think Exelixis is one of these names where it started to run. I'm long. I've been holding it since, around 21, and I'm just going to stick with it. But I think right now, I'm looking for it to, I think it's going to, drop like, 80 cents to $1. But I think there's going to be, an opportunity for it to get down toward 22. And I think that there's going to be, an opportunity there for potential long. Another name that I've been holding that I think is starting to accelerate higher is World Wrestling. There's another company that had just a monster rally, got crushed with the rest of the market, but I mean, now it's back above its 50-day moving average. This is just a company that's just a long-term momentum name. When you look at a stock like this is just a turnaround where it's a small enough company that they just can operate on their own. And this is a company that was broken for a long time that has kind of fixed itself. It's, when a media company or an intellectual property company does well, it can be really a powerful force like we see with software names. So I think this is a company right now that had a great run. The momentum is still there. I think WWE is another one that we can check out. Now, another one that's interesting to me that is not as well known, but this was a terrific software name last year, was Coupa. Now, this C-O-U-P. Coupa is this business intelligence software. If you look at it over the longer run, you can see it had a big rally and it's kind of consolidating here. This company has an investor presentation tomorrow. So I'm looking for a potential. I'm looking to see what happens in terms of this name coming to life. I think if it breaks out through kind of this 67, 68 range, this is another one that could be pretty interesting. If you look at it here, this kind of pattern, it kind of has a name. I mean, you might kind of view it as, essentially a triangle. But the thing is this is a name that has had this longer term uptrend. All the numbers, see this move right here? That was a bullish earnings report back here on December 3rd. But the thing is, at the time, all the momentum was still negative. But now that momentum has chopped its way around. And look at how tight all these moving averages are together. For me, this is a sort of name where this is a growth stock that, it's not, Apple or one of the big names that everyone has been selling. People who are still looking for growth stocks, these are going to be some of the names I think they're going to look to, which is why I've been liking names like Coupa, names like Twilio. These are the names. I mean, Twilio right now, it looks to me like it's going to break out through 100 and keep running. This has been a monster name, but I think another one that's interesting is going to be, Coupa is not as liquid as Twilio, but it's, again, these sort of, software names have been extremely strong. Unlike the semiconductors, they don't have the China risk. These are true, kind of secular growth, sort of companies that are, just on their own program. I think right now the Investor Day coming up in Coupa, this is one also that, if there's some good news, it could start to accelerate higher. And, you could see it, I think a move back toward 80 is, kind of, it could be within the cards. And that's kind of what I'm looking for here on some of these. Now, we mentioned IPOs, some of these names like Pluralsight or some of these names like Zscaler. So I want to mention a little something here that we have. Let me find my scanner. I've been doing a workspace of the week on market action that I've been sharing with people. The thing is, it's difficult to share a scanner. There's no real easy way to do it. It's not actually, embedded in the work site. My scanner is my own personal scanner. I can't really share it with you guys. So I want to show a little scan that I did. Mike Burke helped me with this. So he created this thing called DR IPO for my name. Basically, with this, we set this up in a way that what this scan essentially does is this finds companies that has between 100 and wait a second, I put the wrong thing actually. Anyway, let me show this. This shows companies that have between 100 and 250 days of price history. I put the wrong code in the summary. I apologize for that. If you look over here, I mentioned this. This is a different right here. This is a different line of code. So I'm going to show you this one now. But basically, I set my scanner up. What I said was I want to find companies that trade at least 500,000 shares a day. They have at least $1 billion of market cap, which is 1,000 million. And then basically this scan right here, which is in this case is called DRIPO, it has at least 100 days of price history, but no more than 250 days of price history. And then I also set up so it will only show me ones that are above their 50-day moving average. And these are some of the results that it brought up. Where do we go? Yeah, here are my results over here. Just as interesting, you see some of these names on the list like Pluralsight or, Smartsheet, which is another one that went public last year. It's another one of these growth names. So it's just interesting. So I wanted to very quickly just share how exactly this code works. If I go to my, if I go, for example, the easiest way actually to find, to easily pull up easy language on existing indicators, just go to radar screen. It's called DRIPO. That was what it was called. Go to edit easy language. I want to basically show you how easy this stuff is. Because remember, Don mentioned masterclass. And the thing is that like, some of you guys I know are computer, you're software developers and stuff because I've met you at these events. But, some of you are maybe not. Maybe you're like a doctor or something and you don't know how to code software. The thing is there's all kinds of stuff you can do with easy language, but it's also incredibly simple as well. So, I mean, I am not a software developer, but I've been able to do some stuff. So this is basically the code. And what this basically does is it just numbers. So if you create this as an indicator in easy language, and then you can basically run this scan from time to time, and you can find companies that are essentially, in that ballpark. Because like I said, I think that IPOs, in my view, sometimes the best time to buy them is like, 8-9 months after they go public. That's very often when they start to perform. They start getting added to indexes. People start to say, this is, they've had 3 good quarters in a row. They start to get more analyst coverage, stuff like that. So I just wanted to point that out. This is like my little indicator of the week. I wanted to share this with you guys. And remember, Masterclass, I'm going to be presenting at it. Mike Burke and Jesus have this massive amount of knowledge and information and kind of get you going. I mean, one of the things to remember about TradeStation is it used to cost money to have the software just by itself. We give it to you now as a brokerage client. This has got analytics that other people pay money just to have a competing, some kind of analytics service. You can build these things in TradeStation. It's not that hard. We're always going to be here to help you out with stuff. And I'm going to be holding a lot of webinars. Speaking of webinars, I am doing one next week, which is basically about new stocks for the new year. On January 22nd, the day after Martin Luther King Day, I'm going to be doing this webinar if you want to go and sign up. And I'm going to be showing you a whole bunch more stuff, like some of these different scans that I've been running. We're going to find companies that are growing revenue quickly. We're going to find companies that are pushing new highs. We're going to find companies that have had moving average crosses. We're going to show you how to do that in Scanner. This little thing is just a small kind of sample of some of the stuff that we're going to be doing. One of the other ones, actually, I just did want to mention another IPO company that came up on my scan was Domo. This is another one. This is, small business intelligence software, but, good earnings report. It's just now starting to kind of, get a little bit more seasoned. So I think some of these different names, they're not going to be hugely sort of like liquid or well followed. But the thing is, some of these companies have had some strong numbers, and they're starting to get to the point now where, I think that we've been in a spot where like people have been so obsessed with ETFs and indexes that we almost forgot how to find individual stocks and how to trade individual stocks. And I think now we're in an area where some of these companies that are not as well known is where people are going to go. And the big index things is basically where people are just licking their wounds in a lot of these growth indexes and a lot of these big tech indexes. And the thing to be looking for now is, what are the individual stocks that are newer that will be in an index in a year or two? And smart institutional investors are buying those companies now, and I think that's what we're starting to see. And we know that because they're hitting new highs. They're above the 50-day moving average while the rest of the market is not. That's what it's telling us. So I do think we want to think about that. One other company, it's another kind of longer-term turnaround name that I think is interesting, is Palo Alto Networks. This company had a great run last year. They got beaten up in the fourth quarter like everyone else. Strong earnings right here, though. I think it was on November 30th. Here's a company that has been actually moving higher, basically for the last 2 to 3 months, unlike, the rest of the market. And that's something I think to pay attention to. right here, I don't see a particularly good setup in it, but I do think it's a name that we want to kind of keep on our list and be aware of. I think it's in a range here. I'm not saying that it's necessarily a buy. You can see between this level around 195 back down to 180. That could be something that we see this range get filled. But this is, I think, a name we want to bear in mind because it's been a strong growth name. Cybersecurity, which is one of their things, is an area that is, in a secular growth kind of, regardless of a lot of things that are happening. So Palo Alto Networks is another name that remains on my list. Okay, well, those are most of the things I had here. Let me just look. I want to mention just one of the other things here, if we look at our summary, is, we also look at unusual options activity, and it is interesting because we saw some bullish options activity last week on January 8th in Devon Energy, DVN, and there was a large call roll in DVN. Someone sold, I think it was 10,000 of the April 24 calls, and they rolled up to, right here I have the article. They sold 10,000 of the 24 calls, and they bought 20,000 of the April 28s. So someone is looking for Devon Energy to keep moving higher. They double the size of their position. It's a bullish call roll. But I mean, think about it like this: if you're in options, you can hold those 24s, and say it goes to 30. You're going to make more money by owning twice as many at the 28 line. And that's the way these people are thinking. They're going to basically, when you own more contracts, as the stock moves higher, the opportunity for leverage gets exponential, and that's what they're looking for. So they're saying, look, Devon, going into the beginning of into the spring, this is a stock they're thinking that could be closer to 30, and they're basically taking a profitable position, and they're basically rolling it forward in time, doubling its size. So you want to check out that article maybe. The other one was Schlumberger, SLB. The oil service company. This low down here at, right under $35 was the lowest level this company went since 2005, and they sold a boatload of puts down there at that level. Now, selling puts is, of course, kind of a risky strategy. You have to be very careful that we're not saying you want to do that, but it is interesting to see people stepping in a big way and basically saying, we think Schlumberger in March will hold the 35 level. And you can see that the energy space has been kind of outperforming here. I'm personally not bullish on energy, but the thing is it has really been bear. I mean, it was a very, very, bad quarter for energy, and I think we just have to be careful right now of expecting that the bears are just going to come back that quickly. Now, if we saw jobless claims going to 300,000, if we saw the GDP now from the Atlanta Fed spiking higher, we'd be saying something different, but we're not seeing that. So I think right now, something like energy. I'm not even necessarily, I don't have any ideas right now on energy. I think right now the setups are difficult in the stocks, but I think it's interesting that we've seen bullish options activity in it, and all that kind of gives me a sense right now that there is still this kind of hunt for value, people wanting to come back to the market and own stocks where they feel the downside risk is limited because there has been so much downside already in them. And the thing is they're not doing that in technology really yet. They're doing that in some of these things like banks and energy and things like the Brazilian stock. So I think this is just a rotating sort of area of strength. The market can drift around here for a long time from an index point of view, but the real measures of fear in terms of things like volatility, bonds are not shooting up in price. They're going down in price. We're not seeing the yen ripping a whole lot more. We're not seeing gold spike to new levels. We're not seeing credit spreads widen dramatically. So I just think it's interesting to kind of think about that. From my point of view right now, the S&P is in a kind of, there's no easy trade in it at all, no clear trade in my opinion. It's going to, this is just a level where let's just see what happens at 2,600. I had thought we were going to have more of a chop down, and I think I got a little bit thrown off by the extreme bearishness of December. The question now is, do we just kind of hold 26? And, it could take a few weeks, but we could just hold this 2,600 level on the S&P. Let's go back to that chart. And, I think that there's a risk here of us holding this level and then plowing up through it. In my view, the good news, so to speak, is that that's not going to happen in the near term. We're up 3 weeks in a row. A lot of there are definitely arguments for bearishness here. So I think right now the index has that sideways sort of thing. And if we start to see the downside, though, then you are going to potentially see the bears. But the question is, we need confirmation on it. And it's really easy to lose money shorting something too soon. So I think right now I just want to kind of mention that I think we need to just kind of realize that not all the pieces are in place for the bearish story to come together. All right. So those are most of the things I did share. Now, don't forget, it is actually a long weekend next week because of Martin Luther King Day. So we actually will not have market action next week, but we are going to have the webinar the day after Martin Luther King Day with some of those scans. Don't forget, we publish a lot of articles here on market action, market insights. Most of the stuff I do, but Don and Mike Burke jump in from time to time with some of their information. We do some stuff from time to time showing you different things about the platform. We are always going to be rolling some of that out. There's some exciting new functionality in the mobile platform that we're going to be writing about as well. So, just stick with market action. With market insights, we do have a newsletter here. If you sign up for this, it will send you some of the articles every couple of days. So there is also this sign up here. Great to talk to everyone. Hopefully we'll see some of you down at the master class at the end of the month. And I'll talk to you again, hopefully see you next week on Tuesday the 22nd. What would write, so there's a question here, would write the corrected code for the screener. I think you're asking, am I going to correct the code in here? And the answer is yes. This is actually my distance from 52-week high. With this line here will show me, if I put this line in this thing here called distance from 52-week high, so this I can look, just very quickly show you how this one works. Take the S&P 500. Right here, I have the full members of the S&P 500. And I can see who's closest to the 52-week high by seeing what number is the highest. So Center Point Energy, I don't even know, and this is some random utility stock, but basically this company is within 1% of its 52-week high. And basically this code, you can see very simply how it works. The last price divided by the 52-week high minus 1 times 100. That's going to just show you the percentage off the 52-week high. And this will let you just kind of find those companies that are pushing those highs. And so that's just, another sort of way to find areas that are doing well. So that's what that code is right there. But then I am going to change it to include the code that I put in the chat. Sorry about that mistake. But I will look forward to seeing everyone next week. Hope everyone has a great week and a lot of earnings coming up. Best of luck to everyone, and we'll talk to you on January 22nd. Thanks, Don. Good to talk to everyone.
All the work that you do and providing it to us today. Make sure that you reach out to us. Let us know your feedback on the presentation today. We'll do our best to respond and to try to make this a better offering for everybody concerned. We're glad to see so many traders with us today, but as David said, remember next week we won't be around. It's not a trading it's a trading holiday on next Monday. So join us for David's webinar next Tuesday, but also take a look at the webinar calendar for the remainder of the month. We've got a lot of great educators coming to assist us with our webinar schedule and to talk about their own trading specialties and how you can use them on the TradeStation platform. Have a great night. We'll see you again tomorrow. Tomorrow's morning market briefing starts 1/2 hour before the market opens. Fausto Puglisi, our day trading friend, will be with us for the morning market briefing tomorrow. He'll have show up early because Fausto talks fast and he gives you his market commentary in a very, very rapid fire fashion. So we'll see you tomorrow if you have time to join us ahead of the market open.